Welcome back. It's still your perfect morning starter right here on Channels Television. And this, takes us straight into our discussion as we've looked at the implications of, government services on the economy. And we start with the World Bank's latest report, the Nigeria Development Update. And there's so many legs to this report. Of course, we've seen recommendations from that report of return to issuance of import licenses. And we've had quite a discussion on the implications of this one. Looking through the report as well, you would see that it acknowledges that the crisis in the Middle East is already putting pressure on the gains that have been recorded from the reduction on inflationary pressures back home. So let's try to understand this report a bit further, and of course its implications for not just for the Nigerian economy, but for our relationship as well with the Bretton Woods institution. And joining us now on the program today is Mr. Kelvin Emmanuel, an economist, and of course is the managing partner of, let's get it correctly now, the Energy Consulting Practice. Yes, Mr. Kelvin Emmanuel is the managing partner, the Energy Consulting Practice. He joins us from our Abuja studio. Mr. Emmanuel, welcome to the program.
Bukola, thank you so much. Good morning, and good morning to Kayode and Geoff.
First of all, I'd like you to speak to what may be uppermost in the minds of Nigerians. As I said, the report acknowledges the happenings in the Middle East as it, impacts upon Nigerian economy, the inflationary trends. We've seen, following the ceasefire, a reduction in the price of crude in the international market, of course, which has also begun to gain again following reports that the ships are not necessarily getting easy passage from the Strait of Hormuz. But given that and, a check on the landing price of petrol from the international market to Nigeria is somewhere above 1,040 to 70 naira, and we're buying for 1,245 naira, depending on where you are in the country. But my concern is that the shipping component is not necessarily on that cost. Yet we're buying for 1,245 naira per liter. And is it, credible that off-takers, or if you like, retailers were also buying from our own domestic refinery, are saying that what is added to it is not necessarily significant profits, between 50 and 70 naira for logistics? Can they honestly say that that's just a profit that they're making, or the marketers making a killing on Nigerians from this concern, this crisis in the Middle East?
Bukola, very good question you've asked, and it's important that there is always clarification on this issue. So if you look at the oil market, there is what is called dated Brent and ice Brent. Ice Brent means intercontinental exchange, and it's the most liquid futures market for trading crude oil around the world. Dated Brent is the cost of oil price for delivering physical cargoes now, which is the spot market. The spot market for deliveries within 2 weeks, 14 days. And what you had before the war started about 6 weeks ago is the difference in price, what is called the Brent spread between dated Brent and ice Brent, was not more than $2 a barrel. When the war started, and you saw that most of the first fields that went offline in the Middle East was 3 major fields in Iraq that was producing about 2.8 million barrels a day. Rumaila, West Kano, and Manu. They went offline. Today, 13 million barrels of crude oil is offline in the Middle East. And the reason is from damage of those wells or desalination plants that are feeding water into the wells, to the fact that when ships are not taking crude oil out, the throughput of terminals meant to store crude oil brought to surface daily, it gets overrun. There are no more terminals to store crude oil. It means you have to shut down the wells. So that means 13 million barrels of crude oil has gone offline, because before the war started, about 1,230 ships were passing the Straits of Hormuz on a monthly basis. That has dropped to less than 100 ships per month. So what has happened is you've seen like a widening of that Brent spread between ICE Brent, which is a futures market that has deliveries of between 2 and 3 months, right? And the spot price, which is the dated Brent for physical cargoes that are priced within a 14-day timeline. As of yesterday, the spread difference was $36 a barrel. So, for example, if you look at spot price, the futures market, which is the market that we always look at $96, $99 yesterday, dated Brent was trading at about around $132, $134 a barrel. That's the price. In fact, at the peak, it went up to about $145 a barrel. And then when you add the other shipping costs, you know, you add the insurance costs. Insurance cost has 3 layers. Insurance cost has the layer on insuring the cargo and the crew. It has a layer of insuring the vessel, hull insurance, and then it has a layer of insuring what they call war risk insurance, right? Those are the 3 layers, and the spread has quadrupled over the last 6 weeks. It went up to about $160 a barrel for delivering crude oil to refineries around the world. Okay?
Mr. Emmanuel,
if you
Mr. Emmanuel,
based on...
Mr. Emmanuel, pardon me. The shipping cost, the insurance cost should have been taken off because we are refining at home. So we have a domestic refinery. So the shipping cost from the international route back to Nigeria is not a factor in this case.
No, it is a factor because Dangote needs 19 cargoes to refine on a monthly basis. And today, as we speak, he's still importing 10 cargoes out of the 19 cargoes. And even for the cargoes that are allocated from Nigeria, Dangote is actually not buying directly from the operators upstream based on sections 109 of the PI on domestic crude supply obligations. Dangote is buying through third parties because these operators have signed lifting agreements that they say are stabilization clauses against the provisions of domestic crude supply obligations, which says that NMDPRA is supposed to take a measurement for the shortage of feedstock and send it to NUPRC to ensure that there is a percentage of their output daily that is allocated to the refinery, and that export permits are not granted by the Ministry of Petroleum and Ministry of Finance until the domestic refiner has full supply of its shortage. Right? So Dangote is buying through third-party traders, and they are adding these spreads. They are not giving him crude oil at the ICE price of $99 or $96 a barrel. They are giving him at the dated Brent price of about $132, $134. So that's the price at which we're calculating. And the formula is very simple. If you take dated Brent price, $134 a barrel, multiply it by the exchange rate, let's take it at 1,410 naira per dollar, divide it by 159 liters, which is the number of liters you get when you process a barrel of crude oil. You get the true north of the actual price of crude, of petrol. And if you do that calculation today as we speak, that calculation is higher than the price at which Dangote is selling at gantry. That calculation will bring it to somewhere around 1,240, 1,275 naira a liter, which is higher than the price it's offering for 1,200 naira per liter. So he's running at a loss. And the reason why he's able to still break even is because cumulatively, you know, when you have a difficult situation like this, you spread, you do your crack spread not based on PMS alone. You do your crack spread based on other products that you refine, like AGO, like jet fuel, like other non-transportation fuels, polypropylene crystals, and we're not going into details and the likes of them. So practically speaking, right, he's between a rock and a hard place and saying that, look, do we raise the price of petrol based on the current realities of the market and risk a backlash from Nigerians saying that Dangote is squeezing them because they don't understand the realities of how this market trades? Or do we keep it and run at a loss like it's currently running? If he were to wish, I don't think he would wish that this war in the Middle East started and he's in this position, because as we speak, if you do the actual numbers, Dangote is running at a loss for selling PMS in Nigerian markets.
All right, so there's a lot to unpack. We can talk about the middlemen, the traders in this sense, and whether it's possible to get them out given the PIA. You can speak to that. But the other part we want to speak to, which is one of the big highlights of the report, that is the NDU report, the Nigeria Development Update by the World Bank in Nigeria. And we're looking at some of the recommendations they made, because everything is tied together. The reason why we had to look at these numbers that you've professionally analyzed and how it came down to the PMS price at the pump at the filling station is because right now there's pressure in terms of supply, and we know that Dangote has maintained that over and over, that it doesn't get the number of cargoes it's supposed to get from the NMPCL. So of course the refinery is about 650,000 barrels per day. There's expansion plan, so that comes to about between 17 to 19 cargoes. So if he gets less than that, he has to import, and the premium price being put on even local freighting of this petroleum product. But the World Bank is talking about some of the things that are happening as far as this war is concerned, and that has to do with the windfall. Windfall on one hand is bringing more money to the government, whether it's over 100 or less than 100, we earmark $65, and they're talking about reducing inflationary pressure. The argument can also be when they recommended that they should restore PMS competition by reopening imports so that prices can reduce. The PIA is a deregulated sector. Everyone is allowed to go and bring in whatever they want to bring in terms of petroleum product as long as they have the license. So they're not running foul of the law in terms of that supply chain, if you will. But the question is, given what is playing out now, how can they bring in products that will significantly make prices lower than what Dangote is selling us? Is that a possibility?
Joe, very important question you asked, and I was a bit surprised when I saw in page 14 of Nigerian Development Updates that the World Bank, IBROD, and IDA, released on Nigeria. I was a bit surprised because it's contrary to the PIA currently. Sections 317, 7 to 8 of the PIA says that when the domestic refiner has shown capacity to supply the local market with the daily feedstock, petrol feedstock that he needs, that NMDPRA is supposed to cease issuing import licenses. So really, the government will run foul of the law if it grants new import licenses to marketers to bring in products into Nigeria, considering that Dangote is able to solve 100% of Nigeria's daily petrol consumption. Okay? The recommendation of the World Bank, it's a bit counterproductive. And the reason I said it's counterproductive and it's not in the best interest of Nigeria is because you have a situation where Dangote has successfully, done full backward integration for petroleum and petrochemical refining. And he has been able to successfully, contribute to stabilizing the FX markets in Nigeria, ensure that there's net export proceeds that comes from exporting refined petroleum products. And he's been able to also reduce the demand for FX, for imports of petrol, AGO, Jet A1, and other non-transportation fuel derivatives. So I don't know, for example, why we're talking about industrialization and achieving a $1 trillion economy, and World Bank is coming to tell Nigeria that Nigeria should issue import licenses to allow marketers bring in all kinds of products that historically has not met up with ASTM testing standards for sulfur level, for octane rating, for flash points, for distillation level that are set in the PI. And the PI is very clear on the sulfur level accepted in Nigeria at 50 ppm parts per million in sections 317.11 of the PI. And moreover, I'll tell you, Geoff, I don't even think that the marketers today can land PMS in Nigeria at less than 2,000 naira per liter, because one of the major supply points for the Russian Urals that were used for blending in Lomé and Malta, historically, Ukrainian drones, UAVs, those kamikaze drones that are armed, have actually destroyed a lot of those facilities in Russia. So I don't know how, for the life of me, the World Bank will be saying that, you know, the government should issue more import licenses and bring in products as a way to...
Let me understand. Let's marry the law with everything. Let's marry the law. So if the sector is deregulated, deregulation means multiple players. That's my understanding of deregulation. If the sector is deregulated and we can have multiple players both across the streams, let's talk about the supply element now, people that are bringing in products. So what does the law say if we are able, based on DCSO, domestic crude supply obligation is given to our local refiners, and they're able to supply the local market? Does that in any way stop any importer by law not to also do business in Nigeria, if you get my drift? So Dangote refinery, every other refinery has been able to serve within this shock. So now we're not dealing with the question of availability, we're dealing with the question of affordability. Does that negate the fact that people can still, if they choose to say they want to be importers of the petroleum product, is that against the law?
Joff, so very important question you asked. Now, what the law says is that if the domestic refiner, and it is very clear in 317.728, has met up with Nigeria's domestic demand on a daily basis, that the regulator, NMDPRA, should cease giving import licenses to bring in products into Nigeria. And WTO is also actually clear in its Article 6 on this competition law. And it says that if imports pose material damage to domestic production in key sectors, the government is supposed to apply a tariff to discourage imports. Right? So what you have historically, Joff, is that you've had a situation where under the domestic crude intervention stock, where the government warehoused 445,000 barrels of crude and was using it as subsidy for crude oil swap. So they will take the crude, they will, you know, export the crude, give it to traders or give it to refineries abroad. Under Jonathan, they were giving to 13 refineries. When Mele came, they switched to direct sale, direct purchase. They were giving it to commodity traders. They will now calculate and bring in the equivalent of the refined petroleum products, but they were not bringing in the right volume of refined petroleum products in Nigeria because they were basically inflating the amount of daily consumption and diverting the products. You know, it will land in the ports, documentation will be done, and then the products will be diverted to other ports within Africa. And so that was what was going on, right? So if you have a situation, for example, where DCSO says that you're supposed to provide crude oil feedstock to meet the feedstock limits of the domestic refiner to be able to refine and supply the Nigerian market, number one, they are not providing that feedstock today. Under the domestic crude intervention stock, right, the 300,000 barrels of crude oil that was used as crude oil swap to provide or apply under recovery of subsidy on petrol and freeze the price, the government is not even reporting it to the federal government of Nigeria Consolidated Revenue Fund. If the government says they are reporting it, let them come and show Nigerians and let them explain to Nigerians why Nigeria is operating 3 budget cycles and operating 2024 capex budget and is not able to finance the capital component of the budget. Let them come and explain to Nigerians why is there chronic budget deficit and why is the president going to National Assembly and telling them that he's going to extend the operationalization of 2025 budget into 2026 and there's no appropriation act for 2026, right? So if you have a situation, for example, where marketers, some of them have crude oil refining license, right? License to establish LTE. The regulator has refused to review that license because it's been there for the longest time, and they're not asking them why you're not moving from LTE to ATC and then LTO, right? And they are using that crude oil refining license that is at LTE level as a justification for, you know, importing products into Nigeria, considering that Dangote is able to supply 100% of what Nigeria needs, then there's a disconnect in the operationalization and compliance with what the PIA says.
So, Mr. Emmanuel, I'm reading through the PIA, Section 317, which has been a major point of dispute. And I should say that this matter goes all the way back. Dangote had taken the NMPC to court, importers as well. Over this particular matter, the NMDPRA had to speak on this. But the section which you referred to, this is Section 9. I mean, it's a build-up from 1 all the way to 9. It says, pursuant to Section 8, license to import any product shortfalls may be assigned to companies with active local refining licenses or proven track records of international crude oil and petroleum products. It also speaks to, in section 7, sub 7, says the minister shall set forward a clear transition plan within 60 days. And he had earlier talked about from the government on behalf of the Federation may request the services of NNPC Limited as supplier of last resort to ensure adequate supply and distribution of PMS for a period of not exceeding 6 months. Just to read that word for word from the PIA. But here's a challenge. This matter had gone to court. I understand that Dangote stopped the court processes last year. There was a lot of back and forth. And at some point, the NNPC was saying, well, we have to do this. We had looked through and we think that this is the right time for us to do this. So here's the bone of contention. If you indeed say that importing will be more expensive, so why don't you leave those people who would buy it, and I'm talking about the consumers, to make their choice? Leave the market open. If people want to import, let them import. Naturally, Nigerians will pay where they see that the price is lower and it's more affordable. So why not allow the market do its thing in that sense, if you catch my drift, Mr. Manuel?
Kayode, I'll tell you, very excellent question you've asked. So historically, right, the issue has not been with importation. The issue has been with quality. Now, in the oil and gas sector, especially in downstream, your certificate of quality on your sulfur and your octane rating determines price. A 50 ppm petrol, which is what PIA specifies, and if you read through that 317 that you're currently reading and you go down to 11, you'll see that the ECOWAS had a meeting in 2020, and at that meeting they agreed and issued a communique that the PMS sulfur limit will be 50 ppm, and that the regulators are allowed for a period of 4 years to apply their own discretion and determine what the PMS sulfur level will be. And several regulators, applied that discretion. Nigeria applied it and increased from 50 to 200. And that 11 says that if by 2024, when that time limit expires, the regulator does not come to renew that discretion, that it will revert to what they reviewed it initially from, back to the 50 ppm that was specified at their meeting in 2020 of February 2020. That's what that section 317.11 says. So the kicker is, will they comply with the sulfur limit that is agreed in sections 317.11? Because the quality of the product determines the price. A 50 ppm petrol, the price of it is not the same with a 200 ppm petrol or a 500 ppm petrol. Historically, what they've done is that they've imported petrol that has sulfur level of more than 500 ppm, 1000 ppm, and tests were conducted to show that some of the products that were sold that were imported into Nigeria actually didn't comply with the PI. So if you allow them to import, they will import lower quality petrol that is in violation of the PIA.
Mr. Manuel, right? That is where regulation.
Where you're competing with a refiner that is complying with the PIA.
So that is where regulation comes in.
How is that fair competition?
Are you saying that the regulator turns a blind eye or is incapable, incompetent, such that you're not able to say, well, this is a sulfur content in this product and we're not going to allow it come into the country? Is that what you're saying, that the regulator is incompetent?
Kayode, I am saying it and I'm not missing words. NMDPRA has overlooked historically the quality of the sulfur level that were imported by marketers into Nigeria in violation of section 317.11 of the PI. I'm saying it to them categorically. And if they deny it, let them come and show Nigerians if they have a lab in Nigeria that complies with ASTM standards to test for sulfur level for petrol products that are imported into Nigeria. Historically, they've ignored it. I'm saying it categorically.
Mr. Emmanuel, how much does Dangote refinery sell petrol to other marketers in the country?
So at Gantry, petrol is sold for 1,200 naira per litre today.
1,200 naira?
At Gantry. And you know, when I did about 1,200 naira per litre at Gantry, which means if you go with a truck, if you pass KYC and you go with a truck, you buy it at 1,200 naira per litre at the Gantry.
Okay.
And for coastal loading, I think coastal loading has a difference from Gantry price.
Okay, so for other marketers who buy from Dangote, who sell to us, the consumers, they're selling at 1,255 naira per liter. Are you saying, or are the marketers saying that all the profit they make from buying from the major market, from the refiner, is 45 naira?
Bukola, the petrol market is a tight margin business. It's high volume, tight margin business. It's not low volume, high margin business anywhere in the world. The margin, even for the refiner, is very tight. And I did the calculation for you. I said that if we do the calculation based on the price of dated Brent is trading at around $135 a barrel today. If you look at the ICE Brent is trading at about between $99 and $102, $103 a barrel. That difference is anywhere around $32, $33. If you multiply dated Brent price by the exchange rate and divide it by the number of liters you get when you refine 1 barrel of crude oil, it comes to anywhere between 1,240 and 1,270.
Mr. Emmanuel, that's rather hard to believe. So pardon me, these marketers have to get the petrol from the manufacturer with their trucks. They have to either power that truck with diesel or petrol. So are you saying that 45 naira is the entire profit that they make, even if that's a tight margin price? If you're in that business, is that all the profit you'll be willing to make?
Bukola, I said that petrol business is a tight margin, high volume business.
No, so Mr. Emmanuel, if you're a marketer in that field, is that all the profit you would be willing to make? 45 naira, 55 naira.
Of course.
That's all the profit you'd be willing, despite the risks involved. There are marketers who are bringing in their trucks to get petrol from the manufacturer from other parts of the country, and that has implications on transportation. Is that all the profit you think that they will be willing to make? Or there is more to the petrol price? Hold on, Mr. Emmanuel. Or there's more to the petrol price that they're actually getting from Dangote than is made public to the consumers, Nigerians?
Bukola, I don't know how you're doing the math, but 55 naira.
Because I don't know how you're doing the math
50,000
either. I don't understand your own mathematics either.
No, you're asking me if 55 naira per liter is sufficient margin to be in the business of retailing petrol products around Nigeria, and I'm saying it is a fantastic margin to have.
Just 55
because if
naira.
you multiply 55 naira. Yeah,
hold on.
Per liter, for example, times 50,000
just before we exit that conversation.
It's fantastic margin to have.
Hold on. Just before we exit that conversation, you said earlier that Dangote is actually running at a loss. But Dangote, amid this, is actually now exporting more petroleum to other African countries. By the way, are you open to the book? So how would you know that the domestic refiner is running at a loss?
Because I'm not the staff of Dangote. I'm not open to the books. I'm simply applying like standard calculations that works for every refiner around the world. The oil and gas sector is a very transparent sector, but it's a very complex sector. And I'm saying that this is how refiners all over the world calculate the price per liter and calculate their margins. And based on the calculation I've given you and the variables I've put on the table today, I can confidently tell you that if you multiply dated Brent price, which is the price of physical cargoes delivered to the refiner, by the exchange rate divided by the number of liters in the barrel of crude oil, today is running at a loss. And the dilemma is in is that if he decides and says he's going to increase the price of petrol at gantry or for coastal loading above his cost price, he will run the risk of Nigerians saying that he's running a monopoly and he's trying to punish them. But he's a businessman, and it's a very difficult situation to be in, unfortunately.
All right, Mr. Manuel.
He didn't call for the Middle East war.
Yes. Yes, at the end of the day, what Nigerians want is to be able to afford PMS price. That's what Nigerians want. So in your view, if you can do it in 1 minute, how can we get these products a bit more affordable? I don't want to use the word cheap now. With the present situation we find ourselves, who has to play a role here?
Job, unfortunately, the government did not plan. But even at that, the crude oil that the government was using to apply under recovery, 300,000 barrels per day. Can the government apply that feedstock as like because Nigeria needs about 300,000 barrels equivalent of crude oil to satisfy domestic consumption on a daily basis. Can the government use that feedstock, to apply a discount on the sale of crude to the refiner so that he can lower and freeze the price of petrol to the Nigerian market, and is not subject to all the issues around dated Brent versus ice Brent, shipping costs, interest rates, and all the external factors that are causing shock to the price of crude oil as he gets it, and that is going into pricing petrol in the Nigerian market. The government cannot account today, and I'm saying it categorically, Geoff, the government cannot account for the 300,000 barrels of crude oil it was using to apply for under-recovery to subsidize petrol in Nigeria before the president announced in 2023 that he was going to remove under-recovery for petrol subsidy in Nigeria. The government cannot account for it. Yeah, there's nowhere in the revenue line of the federal government of Nigeria where you can see the revenue accretion from removing petrol subsidy in 2023. Where is the crude oil?
Okay.
Where is the crude oil?
Because the
question we need to ask.
Because the argument is always the fact that removing subsidy has increased FAC. So where is the increase in FAC coming from if it's not from the subsidy?
Exactly. Where is the increase in FAC? And Geoff, today we're debating pipeline security. NMPCMD is saying that it has led to increase in daily output for crude.
No, what I'm saying,
before
I let you go, what I'm saying, Mr. Manuel, is that they are saying that for removing subsidy from, let's say, PMS, that's why we're seeing an increase in FAC. Is that a tenable argument?
That is not a tenable argument, because the government cannot show you anywhere in the revenue line where you can see accretion from the 300,000 barrels of crude oil that under domestic crude intervention stock that was applied for under recovery or crude oil swap to freeze price of petrol in Nigeria.
Maybe when we get the minister.
And why is the government giving 110,000 barrels of crude to militants to do pipeline security in Nigeria, when you have the Navy and you have the Nigerian Army? And they are underfunded.
That's a heavy allegation.
Why are they giving 110,000 barrels for petrol pipeline security?
Yeah, Mr. Emmanuel, that's a heavy allegation.
And it's off the balance sheet of the federal government.
That I'm sure the government, I'm sure they are listening to this allegation that you've leveled against them. Maybe Minister of Finance or whatever is the proxy will come and respond to that, as well as the NNPCL as well, because this under-recovery matter has been a big a big issue, if you want. But I must thank you. That's how much we can take. Always an exciting conversation with you when it comes to this sector. Kelvin Emmanuel, thank you so much.